This chapter concerns what we would call the economic cycle or the business cycle, that is, other overall business trends and how they affect international trade. So by the end of this, you'd want to understand how the global economic cycle is going to affect international trade, and also how the cycle in one particular country or region could be linked to another one, a nearby country. So generally, if you want to go back to your grade 10 introduction to business, it's the business cycles. This particular chart here, over time, the economy slowly grows, but it doesn't grow in a straight line. It goes in a bit of a curve. There's peaks, there's contractions, there's troughs, there's recoveries, there's another peak. It's always going up and down, and it's either in a stage of expansion or contraction. So again, here would be another chart. A full business cycle would be from one peak to another, or one trough to another. That would go all the way down, including the contraction, bottom out. It starts to recover again, the expansion, and then it ends with another peak. So one full loop would be a business cycle. So what happens in each trend? Well, to start with the expansion is when the economy begins to grow again. Businesses hire more, the wages go up because there's more activity, production expands, profit expands, and growth starts off slowly, and then as people realize that there's a recovery in progress, the rate of growth increases and the curve becomes steeper. Well, then it tops out. We reach a case where people are consuming about as much as they can, factories are producing as much as they can. There's a limit to how much, to growth. And so it's sort of slow growth rate slows down, and then people also become worried about what might happen next. They worried about that slow growth rate. It's going to actually then turn into a negative growth rate. And that would be called the contraction. The economy slows down, people might be laid off, factories might close or might have reduced hours, offices or stores might close or again reduce how many people work there. And then this just leads to less purchasing, an increase in unemployment, and then that causes the rate of decline to become steeper, and the contraction is steeper. You may hear the term recession along with contraction, but just a reminder, a recession has a very strict definition: 2 consecutive quarters of negative gross domestic product growth. So it's going to take us 6 months to identify whether there is a recession or not. We can say that there is a small contraction, it might take a month or two, but a recession is going to take 2 consecutive quarters of negative growth to be formally announced. And then it bottoms out. Production reach their lowest levels. The economy, it finishes the recession. There's other opportunities. New technologies begin to occur. Trade, other events happen that spur the economic growth again. People start getting excited again about consumer confidence, and then it turns up again and enters into another expansion phase. So right now we're in a worldwide recession because of COVID-19, but here is how it was going before, in the most recent full year before the COVID-19, and there was a small amount of growth. Canada's growth is about, they target about 2% per year, so things were slowing down. Was a little less than that, but it was still around the target. Regions tend to have growth rates that were correlated. So before COVID, you could see that in Africa there were some growth rates. In Asia, a lot of the countries there were growing at a very, very high rate. However, now, just because of the shutdown, the production being slashed, people losing their jobs, in 2020 there is a big recession. So, how do you measure the economic cycle? How do we know what stage we're in? Well, primarily it's looking in GDP, gross domestic product growth rate, from the same period of the previous year. And you have to understand that there's often a delay of a few months until all the data is known. So sometimes other indicators might be used to fill in the blanks until all the transactions have been processed and GDP can be properly estimated. And these other kinds of indicators could be home construction, manufacturing, hours work, consumer spending, things that Statistics Canada could track. Um, the person um, these are things that can be tracked by Statistics Canada and also the Conference Board of Canada, which is an organization that rates economic performers and categorizes the indicators as leading, lagging, and coincident. Like leading, stuff that would predict economic growth, lagging, events that have happened afterwards that confirm what has happened, and coincident, things that are simultaneous. And leading indicators can be, manufacturing hours, because a good has to be produced first before it can be sold. So if manufacturing hours slow down, that is going to impact future sales. Stock market indices, consumer expectations, because they affect consumer confidence, which is a big leading indicator. Housing starts, because once a house starts, it has to be finished, and there's going to be a lot of activity. And also, if people build their house, they feel confident about things. And jobless claims, because again, if people start losing their job, then they're not going to be able to spend money the next few weeks. So coincident indicators just reflect what's happening. For example, if companies are feeling good, they're doing well, they might give people a higher wage. If they have to fill a lot of orders, they might schedule people to work more. Trade's going to be doing well. So these are some things that can happen at the same time and be reported fairly quickly. And then lastly, there are the lagging indicators, which might reflect a little adjustment that an economy went through, or just confirms what's happening. For example, the price index, which is a basket of goods. If there's a lot of money going around, the price index is going to raise. The ratio of inventory to sales. If something's not sold and it's kept in inventory longer, that could mean that there's less spending. If there's consumers are borrowing more money, if there's more credit than income, that ratio changes. That reflects that they might be in a little financial trouble. So these are some indicators you can look at afterwards to confirm what has happened. So this is an example of Europe and the consumer confidence indicator, how it sort of balances out. And you can see the gray areas are the recession, and there's red is sort of if you'd ask people what they think of the economy, and blue is more of an index made from other economic indicators. And so you can see when the recessions happen that the blue line, kind of the line created by the statisticians, it's predicting the recession, the big financial recession in 2008, and another one in 2012, and the red one, people's beliefs, it started going down before the recession happened. Same thing in 2012. And we're not in a recession yet, because we haven't had the 2 consecutive quarters, but you can see that the both went down before the economy started having a lot of difficulties. And although things have rebounded a little bit because of the economy opening up, the consumer confidence is still a little hesitant. You might see that people are still saving money. They're unsure what's going to happen next. So they're not totally confident, and that might be a sign that the recovery is not going to be an immediate bounce back, but we'll see. So what does the government do to manipulate this? They can try to change consumer or business habits by providing incentives. This would be Bill Morneau, the Minister of Finance, would do this in Canada. Changing the tax rate. The lower the tax rate, the more people will spend. Adjusting corporate or sales taxes for spending on big infrastructure projects like road paving or subways or bridges. That will get the local economy going. Spending on social programs to give people money. So, for example, the uh, COVID-19 benefit for everyone, for um, rent for commercial properties, the benefit for seniors. Those were things that were done to get money into the economy to sort of arrest the contraction and turn things around. The other type of lever is monetary policy. This would be done by the Bank of Canada, and they primarily adjust the money supply available in Canada. So if there's more money available, there's people will spend it. So they can do things by buying securities so that money is released into the economy. They can also adjust the prime overnight interest rate, which is the rate banks pay when they borrow money from the Bank of Canada, and so it's going to be reflected in the rates they charge for mortgages and loans and so on. So they might lower that in times of crisis to encourage more loans to be given, to encourage more mortgages to be given. They'll lower the interest rate to encourage banks to make it easier to get money in terms of a loan and put it into the economy. So here would be a chart of the Bank of Canada's overnight rate, and it's been pretty low in the 2010s. In the 80s, it was much, much higher. So you can see in the global financial crisis of 08, 09, a gradual decrease. Usually they do 0.25% at a time. Sometimes they call them basis points. A 0.25% is 25 basis points. So changes are usually 25 basis points, 50 basis points. It stayed very, very low until Canada started coming out of the recession. And even during the period where it was growing in the 2010s, it still was very low to encourage money to be out in the economy. But to avoid inflation, it raised up a little bit. And then you can see as COVID-19 happened, the dramatic reduction to get it back to its lowest level ever of 0.25%. So that's done by the Bank of Canada. Tiff Macklin is in charge of that, and the two levers, fiscal and monetary policy, allow the government to manipulate the economic cycle. If you'd like to learn more about the economic cycle, here are some resources. The Conference Board of Canada, the Department of Finance, and the Bank of Canada. They'll often post press releases stating what's happened, or in the case of the Bank of Canada, they'll explain why they made a decision and what the reasoning was for their particular monetary policy.